Shiv, welcome to the show.
Excited to be here. Thanks for having me, Tom.
Now, I spoke to quite a lot of marketers on the show. They're my favorite types of people. And today I'm excited because we're going to be coming at marketing from an angle of another area that I don't have any real experience in, but I'm also quite interested in, and that is private equity. And so, Shiv, I would love it if you could just give us like very simple intro to private equity and then also how they look at creating value.
Yeah, it's a very unique space and it's difficult to understand unless you're actually inside private equity. It's like one of those clubs that you have to be in the club to get in the club. And kind of how I got into it is I was previously the CMO of a software company called Wild Apricot, and we sold it to private equity. And then the PE firm that bought us, they bought us in 2017. They sold us to a different private equity firm in 2018. And so going through those two transactions, I got exposed to this world that previously I didn't even know existed. And the things that we were building on Wild Apricot, we'd built our entire go-to-market through marketing and demand generation and inbound, and a lot of principles that would be more common to the general marketer. But we had done that without a sales team and taken that business to 20 million in annual recurring revenue. And both the PE firms that bought us were flabbergasted or just amazed at the fact that we didn't have a sales team and we were able to do that. And so they started pulling me into their other investments and asking about how they can leverage marketing to grow those companies as well. And so that's when I saw this opportunity to found this current firm. And we started working with private equity firms to almost as a strategic consulting practice, like think of it as like a McKinsey of marketing. And then we started working with them to figure out how they can scale their portfolio companies. And now we have like 50 to 60 private equity partners. So that's the background of figuring out what private equity actually cares about. And then in terms of what the substance of that is you have to really understand their dynamics. So private equity is a different asset class. Like most people, when they hear about investors, what they're really thinking about is VC investors. So you hear about companies all the time. The press releases are like company X raised $100 million or a $10 million Series A round. And we think that that's the win. But what that really is it's a company that's in an earlier stage that has revenue, that has traction, that needs capital to become an actual company that's worthy of being acquired eventually. And then the question is like, well, who's doing the acquiring? And that asset class is private equity. And so their business model is completely different than VC, where the VC is trying to make thousands of bets and some percentage, a small percentage of them really pay off. And once in a while, you have a unicorn like an Uber that really takes off. But in general, they're placing a lot of small bets on a lot of companies. On the private equity side, they're buying more established companies. And so their business model is they raise capital from limited partners. These could be endowments, retirement funds, pension plans, et cetera. They use that capital to find companies or assets that have a predictable revenue engine, have profitability, have stability so that they know that whatever capital they're deploying will be returned. And then they acquire that business usually as a full buyout or majority stake, and then they have full control. There are minority private equity investors, but there are fewer of those than full buyout funds. And then their path to value creation from there is, okay, I bought this company. I want to optimize it and grow it faster, but not at an alarming rate. Like one of the things that in the VC world that you'll see is growth at all costs and burn capital, lose money to build a bigger business. In the PE world, it's the opposite. We want to grow responsibly, be profitable, and then eventually that leads to a more efficient business that they can then flip. So they might buy a business for 50 million and eventually want to sell it for 75 or 100 million. And that would be a really good outcome for them over a 5-year period. And so once you understand those dynamics, you start to look at every function of the business differently. You start to look at sales differently. You start to look at marketing differently. You start to look at product development differently. And so having that insight, as I started to see that, I saw a major opportunity in helping those companies figure out how to leverage marketing to scale those companies faster with the principles or the constraints that are on those businesses.
So how do you now look at marketing differently from the PE standpoint?
Yeah, it really starts with understanding, like, as if you're a founder, and I like to compare to a bootstrap founder. a bootstrap founder behaves very differently than a VC-backed founder. If you're playing with your own money, you're always like, let's say, even if you're starting a small company and you put $100,000 into starting it, so $100,000 is a lot of money for an individual, and you would track every dollar and where it's being spent, whether it's worth it to spend that money or not. Should you potentially reallocate it to something else that might be a better fit for that spend? Whereas a VC founder, because they have the capital behind them, it's not their money. They tend to make more aggressive decisions, and in some cases it's a good idea, but in a lot of cases it doesn't pan out, where you have a ton of waste, but you can't see the waste because you have all this money behind you. So private equity it often operates more like that bootstrap founder, but at a scaled up level. Whether you're 10 million, 100 million, billion-dollar company, all of the metrics that would matter to you as a bootstrap individual matter at that scale. So do we have the right team size? Do we have the right budget allocated to the right channels and programs? What is the efficient frontier? Like, maybe we can spend more, but the time it takes to recover our marketing investment would be 5 years plus. So we're not going to do that. Whereas in a VC case, you would do that because you want to just show that you have revenue growth. And so that it completely flips the decision making in terms of how you deploy capital, and what kind of patience you have, and what kind of constraints you put on the model.
So more of a focus on customer acquisition cost.
Oh, 100%. I mean, that would be one of them. Really, it starts with data across the board. There's a couple of metrics. One really major one is called the Rule of 40. And it's a combination of growth plus profitability. So if your growth rate is 20% and your profitability is 20%, or your EBITDA is 20%, you are 20 plus 20 is 40. That means it's a healthy business. You could have a lower growth rate, like 5%, but you could have 60% profit margins. We've seen companies like that, and that is also a healthy business, right? So in general, they try to optimize for that Rule of 40. And then within that, you start to think about, well, if I have growth as my one metric and profitability as my other metric, what are all the things that roll into affecting each of those metrics? So customer acquisition costs, like you mentioned, affects revenue growth. We could deploy 10 million more dollars into marketing in a particular business, but if our customer acquisition cost or break-even point on that is 26 months, that means that our profitability number is going to come down. So you're always kind of trading that off. On a similar way, you might look at pricing and look at your gross margins, and you want your gross margins to be above 80 or 90% in a lot of cases, especially if it's a software company. And so you can drive a ton of margin expansion with pricing as one of the levers. So understanding the 15 to 20 things that you can do within each of those two areas goes a long way. And then you got to, as a marketer, because we're talking about that right now, is really thinking about, how does marketing fit into that overall puzzle, and what role does it have to play in each of those instances?
In the wild apricot example, can we go into like examples of how you're doing marketing pre being owned by private equity, and then how that changed after you became owned by private equity?
Yeah, I'd say in Wild Apricot, or just any other entity, pre or post. And my first book is called Post Acquisition Marketing. For that reason, is one of the number one use cases where we get brought in is right at the point of acquisition. So when a company is acquired, they're doing something well because that's what makes them worthy of being acquired in the first place. But once they enter this environment where there are institutional investors involved, and there are other things that you're driving towards, the behavior needs to change. And I'd say one of the biggest things that changes at that point is how heavily you leverage data to make decisions. I'd say if private equity had a language, it would be data, and most companies don't speak it, because especially if you're founder-led, founders have a ton of power inside organizations, but they also have a ton of expertise that builds a business to a certain point. And one of those skills is actually their instinct, because they know the market, they know the product, they know the customer, they know where the dials are inside their business. And so a lot of them are operating on instinct, but when you operate on instinct, it's not institutional knowledge. It sits with one or two individuals inside the company. And so that needs to be translated. And so how do you translate that? You need to have the right data model for every area of your business. And you would be shocked. Like, we come into companies that are 100 million plus, sometimes close to $1 billion in revenue. And the larger a company gets, the more their data is just a disaster. At 10 million, it can be a mess, but it's fixable. The fix is simpler. At 100 million plus, you have multiple product lines, multiple geographies, multiple business units, and the data is in different systems, and nothing is tied together. There's a lot more complexity there. So the challenge there, and the path to transforming those companies is to first wrangle the data and get it in order, and then leverage that to make better decisions. And the more you are disciplined before the acquisition and have that approach, the more success you'll have afterwards, or at least in the first 100 days post close. If you put in those frameworks in place, it becomes easier to scale in that private equity environment.
Can we go into a specific example of how marketing changed, like pre and post being owned by private equity?
Yeah, so I'll just give you general stories that I see across the board in every client. So in a lot of companies, they will have website data in Google Analytics. They'll have marketing data in HubSpot. They'll have sales data in Salesforce. And they look at revenue very holistically. So, hey, this month we projected to do 10,000 more in MRR that we would land. Are we on track or not? And in a finance level, you have a pretty good idea of whether you did that or not, and you can kind of run the business that way. What you actually want is you want every component that rolls into that $10,000 in MRR to be defined. And so, for example, knowing all the way through what from lead to MQL to SQL to close one, what are all your conversion rates? That's at a global level. Then knowing your conversion rates at every channel, whether it's paid media, events, content, SEO, webinars, everything else, knowing your conversion rates there. Establishing an acceptable cost per lead. This is a metric that I preach to a lot of companies to understand, like, how much can you spend to acquire a lead? And that answer is dependent on those conversion rates, but also on your average sales cycle. It's dependent on your average deal size, and knowing that. So if your deal size is 100,000, like, you can spend a lot more to acquire that customer than if your average deal size is 10,000. Makes sense. And so understanding that, and then being able to measure or figure out which channels, activities, and campaigns are efficient, which ones need to be optimized, and which ones should be probably cut. And just by going through this exercise inside companies, and we do this all the time during marketing due diligence or post-close, we find at least 30 to 50% of spend can be cut or optimized, and you can find 30 to 50% more pipeline. In some cases, we found over 100%. Like in one company that we worked with, we helped them save about $25 million in spend, and they only lost $1 million in revenue. So it's a net gain of profit of $24 million. And that's without looking at new things that the company can do. So the more you set up that data infrastructure and then set that up as your language, and then you have that feedback loop to make adjustments on a weekly, monthly, quarterly basis, that's what you bring into your board meetings to be able to educate the CEO and the board. And I'd say that's one of the other gaps that I see inside marketers, is that they don't know how to speak that language either. Like, you could have a phenomenal SEO marketer or paid media marketer, but they're not able to contextualize it in what matters to the business, what is happening at that board meeting level in terms of overall objectives of the business, how they're thinking about M&A, what their profitability targets are, what their revenue projections are. To be able to bring all of that to the table changes how you're perceived and how initiatives in marketing get approved and not approved. So the more we rely on data and bring that and kind of make it a shared problem that everybody understands, then marketing eventually ends up getting more budget, because then you can say, hey, look, here's what I'm cutting. here's what I'm scaling, here's the ROI on the spend, and I need X amount of more dollars to now scale up to get to where we want to get to, because I did the math, and based on the revenue projections, we're currently under budgeted on marketing. And here's how I would deploy that budget in terms of programs or headcount or anywhere else I need to deploy it.
So what I'm hearing is that private equity companies just first track the data and then are very vigorous about how they would approve or disapprove investments based on those numbers.
100%, 100%.
So would you say that's the biggest difference between how a private equity run business versus a founder run business would operate?
I would say that that's probably one of the biggest differences. I think the financial tracking and budgeting and all of that makes it all come together, it is just not there in most founder-led businesses. There are rare exceptions where you have a very seasoned entrepreneur or founder that has puts those things into place as well. But in general, founders don't run their businesses that way.
Got it. Is there any other big difference that the private equity owned company, how they would run a marketing function?
I would say not just, I would not isolate it to marketing. I would just say that when you're thinking about generating enterprise value, because when I use the word enterprise value, because when you get acquired, the investor is paying a pretty high multiple on revenue or EBITDA to buy the business. And the only way the private equity model works is if they can flip the company. For the most part, there are some funds that are just buy and hold indefinitely, but in general, they have a hold period of 5 to 7 years, and they do need to flip the business. So in understanding that, the question becomes then, what are all the main value drivers at a business's disposal? And the better you can pull those drivers and make adjustments to the company, the more enterprise value you'll drive, and the more you'll be able to achieve that objective. And you want to make sure that the price that you buy the company at is not inflated, because you're kind of climbing uphill to catch up to that valuation. And we've seen companies struggle with that, where when the market was kind of much more friendly, multiples were sky high like 2, 3 years ago. And now multiples have come down a lot. And so there's far fewer PE transactions because they're not able to exit at a higher valuation than they bought it for. So then the question becomes, well, how do you drive value? And we're big proponents of organic growth drivers. So there's organic growth and inorganic growth. When people think, well, organic, they think you're talking about SEO, but organic is what's at the disposal inside the company. And inorganic would be by acquiring companies or merging with companies and things like that. And on the inorganic side, that's work the private equity firms do regardless. They'll do add-ons or bolt-on acquisitions to help you grow the enterprise value of the company, but then they'll also find efficiencies. Like if you have 3 companies that come together, you might only need one marketing team that manages paid media spend for all 3 business units, and that becomes a cost-cutting opportunity that you've got. So there's things like that you can do on the inorganic side, excuse me. But on the organic side, there are only like 5 or 6 major levers that you can think about, right? So you got to acquire more customers, and there's components inside marketing and sales for that. So you can be more efficient with your marketing budget. You can launch new channels or campaigns that can help you land more customers. You can deploy capital into making your sales team more efficient, improving your sales processes, improving sales enablement. So all of that is in landing new customers. Number 2 is you can expand existing customers. So you can either sell more seats, increase the number of products they're buying through cross-sell and upsell. You can find a way to increase prices, and that becomes a way to expand margins. And so all of those tactics are available. Third is you can retain customers at a higher rate. So lower churn rates, improve loyalty, figure out those levers that can help these customers use your product more often. And as part of retention, I also think about things like, are you bringing in additional business because you are a loyal customer? So retention is highly influenced by customer satisfaction and NPS, and that drives, which is the 4th lever of like referability and organic growth through word of mouth and and all of those things. Inside most companies, you have to look at all of those and then have a prioritized list of where is the highest leverage item. And inside every company, the answer would be different. For example, if your opportunity to close rate is like 40%, to get it from 40 to 50% is going to be incredibly difficult. In general, 40% is an exceptional close rate when you have a really good deal on the table. And so if you have a business like that, that's likely not where you should focus your resources. So you may have your sales team telling you they need sales enablement content or additional sales tools to help them close deals, but that's probably not the best use of your time, money, resources. On the flip side, that same company could be really bad at converting an MQL to an SQL. Maybe they get a ton of leads in the door, but they don't end up escalating to an opportunity. Well, in those cases, the answer could be very different. You may need to improve how you nurture those leads. You may need to create more content. You may need to educate them more. You may need to have more touch points to get them to that stage. Or it could be that you're bringing completely the wrong types of leads, or there's a lot of inefficiency in the types of leads that you're bringing in, and that's why your conversion rates are low. So you got to understand what those avenues are in that case. So again, depending on the business, you would prioritize that across sales efficiency, marketing efficiency, pricing, cross-sell, upsell, retention, referral, and all of those areas. And then you'd have your top 3 things that you're going to focus on to drive value for that business, and you'd make that like almost like an annual priority for the business, and look back in 12 months to see how much progress you've made in that. I'd say most companies should be running like this, but they don't, especially when you are burning capital. You don't think like this. What you actually do is you say, we're going to do all of it. We're going to launch a partner program. We're going to improve prices. We're going to launch a new product. We're going to overspend on Google Ads. And so there's never an opportunity to trade off. But instead, in this kind of environment, you have to make those kinds of decisions, and it leads to a better outcome because it really forces you to make a decision on where you're going to focus your limited resources.
So those 4 things you mentioned, they're slightly broader than marketing's remit. I think maybe marketing can help with 1 or 2 of them. But really, I think what you're saying, those 4 levers are like the leadership of the business is running their project, right?
Yeah. So I have a very broad definition of marketing. And the reason for that is if you think about it in terms of the limited areas that people understand, whether it's product marketing or demand gen or content, you can be super focused on certain things, but miss the bigger picture of the business. And I often talk about this concept of being a C-level marketer. And I was mentioning to you before we started this episode, we just launched a course and it's called C-level marketing. It's because people, when they think about marketing, they live in the realm of tactics or even like strategic things that are functional or department focused. One of the first things marketers are taught as they're growing in their careers is to become a T-shaped marketer. It's become really good at paid media or SEO and really become an expert there, and that will help you grow your career. And that's true to some extent. But what ends up happening is that you cap out, and where you cap out is probably like a demand gen director or senior manager of demand gen or something like that. And then from there, it's like there's a frustration because you can never cross over to becoming a VP or a CMO because there's something missing, and marketers don't understand what that is. And even people that I meet we come into so many clients that have existing VPs or CMOs, and I'd say it's very rare to meet a seasoned CMO that truly understands what moves the needle for a business. And so that gap between being a director or a true CMO is understanding what moves the needle for a business overall, and then how each function plays into that. So when I say broad definition of marketing, the gap is knowing what are our revenue projections for the year, what do we need to do from a product standpoint, what do we need to do from a customer success standpoint, As you start to look at every area of the business, there is an important role that marketing has to play in every section of that business. And it's your role as the marketing leader to make sure that you are playing the right role. So, for example, cross-sell, upsell, you could easily make that an account management problem or a customer success team problem. But really great account management involves one-to-one content for those accounts. And who's going to create that? It's not going to be the sales team. So somebody on the marketing team or the content team needs to sit down with sales, look at the accounts they're going after, look at the cadence or the outreach plan for those accounts or those contacts, and then help create the right content that enables that outreach. And you could do this for everything. You could do it for pricing. If you're going to launch new prices, like everybody's probably gotten that email from Netflix on we're increasing your prices like every few months that they do. That's not just a pricing team sending that. There's a ton of marketing work that goes behind that. And so every single area like that, if you were to map out what marketing responsibilities are there, then you can start to think about how marketing is actually moving the needle for the business. If you limit it to things like website traffic and MQLs, you're just going to live in that world. And this is actually one of the reasons why marketing is understaffed inside companies, because what they'll do is, because that definition is so limited, they'll never be able to get approval for a larger team members or a larger team. But if you think about, oh, we have to play a role in pricing, we have to help cross-sell and upsell, we got to support the partner program, we have events, we have to do product marketing for this new product launch, start to put all that together, you actually need people to do that work. And there's a clear ROI behind that. And so that's why I'd say going with the broader definition usually leads to better results.
I see. This makes total sense. We're really saying that the marketer or the CMO, when we get to the senior level, needs to have the broader view and really understand how marketing can impact the business. Any final, I guess, gems of wisdom for marketers from your PE / marketing wisdom?
Yeah, I would just say that this last stream of thought that we were on is really the key, right? So it's definitely important for the CMO to think about that. But I'd say that needs to cascade down throughout the organization. I'll give you a very common frustration that I see inside marketers is like they want to level up in their careers or be compensated more for their roles. And a common argument could be like, hey, I'm doing an amazing job with webinars, or I'm doing an amazing job with SEO. And it might be true. You may have written a ton of blog posts, you may have increased website traffic, but if despite your work, the business doesn't grow, if despite your work, the profitability or whatever doesn't improve, then it almost doesn't matter. It's like, you did this, which is great, but there's a lot more that you need to make an impact on to grow your career. So, and the higher you think as in terms of levels, right? So I like to think about it as like 5 levels. Like level 1 is you're just thinking about what you do. Level 2 is you're thinking about like a sub function like SEO or paid media or whatever. Level 3 is you're thinking about the department and what overall marketing needs to do. Level 4 is it's cross department, like you're thinking about product or customer service or anything else. And then level 5 is you're thinking at like a board level, at a business level. And I would encourage everybody to start to think about the business from that view or their role from that view, because you have a role to play within that overarching context. And if you understand that, your odds of success are significantly higher. So that means trying to get your hands on what is the budget for the year? What are our revenue projections for the year? Trying to read through detailed spreadsheets and forecasts and all of those kinds of things, looking at metrics in other departments, setting up conversations with your CFO, like actually asking questions that maybe you don't have access to inside your role so that you can get access to that data so that you can make better decisions in your role. The more of that you do, the more of an impact you can make in your role, and that will help you grow in your career as well.
I feel like this is something that marketers need to hear. Shiv, we will link to How to SaaS the business. We'll also link to the course that you released this week and the book. Is there anything else we should mention or link to?
No, this was great. Thanks for having me on. And if anybody wants to connect with me on LinkedIn, they can find me there. I post a ton of content.
Amazing, Shiv. Thank you for coming on.
Thanks, Tom.